Well, hello everybody. Welcome to our latest video and Happy New Year to you. Hope your 2026 is starting off good. And I'm Michael Moskal, Director of Investments at MGO, and I am here today with Brad Wingler and Justin Petrus. And we are going to go through what happened in 2025, which was a good year, and then we'll give you our 2026 outlook. So on the screen, what you're looking at is there's four hot topics that are affecting the way that we're investing your money. You know, gold and silver have garnered a lot of headlines, and you see the bullion over there, the picture of that, in the last year for sure. But, we'll talk a little bit about how that trend's been happening. We've owned gold and silver in our portfolios going back, what guys, about 2.5 years ago, maybe 3 years ago, we started buying. And I remember gold at the time, maybe it was $2,000 an ounce, something like that. And today it's what, 4,700 or something. So we've seen some really good gains with our precious metals holdings. The picture in the middle, that is the president, of course, and Jay Powell, who's the Fed chair. And, the politicians, and not just the president, but many of the politicians, AOC, Elizabeth Warren, many Congress people, they put a lot of pressure on the Federal Reserve to lower rates. And we'll talk about what that means. And the picture you see with the people that are pulling part of the globe and going home, that's all part of the deglobalization cycle that we've been watching, which affects your investments. And it's something very different than what we were used to for 30 years, starting in the late 80s with globalization. So we'll talk a little bit about that. And then AI, artificial intelligence, is a trend that's been happening for the last 3 years that's been very, very beneficial to the US economy and the investment markets. All right, there we go. A little technical difficulty. All right, just briefly, this is our 87th year in business, and we were started in 1939. The names that you see there are our MGO Investment Advisors team. We have a team of experienced people, as it says on here, 159 years experience with our team. I thought this was interesting, Brad and Justin, that if you go back to the 30s, these were the original Magnificent Seven stocks. The Mag 7 stocks today, of course, everybody knows the names: Amazon and Apple, Microsoft and Metas, and those kind of companies. But back in the 30s, there was also a group of stocks that were dominating the stock market. So if you look here, some of them, these are names most people know. Some of them are around today still. AT&T, General Motors, IBM. Standard Oil is not. That was the John Rockefeller Standard Oil that got broken up into different companies. Those companies are still around today, right? We got Exxon Mobil, Chevron, BP is part of that whole group, General Electric, DuPont, and what's the USS?
U.S. Steel.
U.S. Steel. That was big back. That was very, very big. Steel industry is still very big, but it was even bigger back in the 30s. All right, Justin, you want to guide us through some of performance for 2025?
Yeah, we'll take a look here at the market scorecard. So for 2025, we had our equity ETF portfolio. Total return was 22.7%. And then to look at some indexes here, the S&P during that same time period was up 16.4, while the Dow Jones Global ex-US was up 28.5. And then we had the Bloomberg US Government Credit Index up 7.6. So a couple things that are interesting of note here. Our equity ETF portfolio last year actually outperformed the S&P 500 by a little over 6%. So that's very, very happy with that return there. Cumulatively, over since 2022, the equity ETF portfolio has risen 49.7% versus the S&P being up only 44.5%. So very pleased with our performance of our equity ETF portfolio here. But just wanted to take a look at the scorecard and see where we're at here year to date.
Yeah, a couple comments, Justin, on this too. It's interesting with the S&P 500 how high the technology weighting is in that index.
Yeah, the Mag 7 actually makes up about 35% of that index right now.
Yeah, which is a lot going back historically. Remember, that's not an actively traded fund or something. That's just an index of 500 companies. And that's 35% weighting in 7 of the 500 companies is a lot. So you just got to watch that index and be careful when investing in that index.
Yeah, it's one of those things that are pretty commonly misunderstood, that people think of the S&P 500 as a good gauge for the market as a whole. In reality, that's really not the case.
Yeah, yep, that's a very good point. One other thing, the Dow Jones Global, the DJ Global XUS, that's non-US stocks, it's foreign stocks, which Justin, I think, had a malaise if you go back to 2022, even beyond, really, from the 20 teens, have been underperforming US stocks
Mhm.
up until this last year. Up until 2025, they kind of broke out and had a really good year. We are overweight in that MGO equity ETF portfolio. We're overweight in the foreign sector. I think it's 33% of our portfolio is in foreign stocks at this point, which is the highest weighting we've had in non-US since 2011. So it's been a
Yeah.
long time since we've had such high weighting in non-US. And I think our plan, at least for 2026, would be to keep that weighting for a host of reasons. One reason would be that the European Union is projecting to have double-digit earnings growth with their corporations for 2026, which is very high. So that's something that we would expect their stocks to do well for the next coming year here in 2026. Brad, you want to take the bottom part of
Yeah,
this?
I'll take that. But also just one other point on international. International, if you look internationally, what did well? A lot of countries did really well, and as well as things went in the U.S. last year. You look at places like the UK was up 21%. You had Germany up 23%. You had Japan up 26%. So it's not just, there was only a handful of countries that actually underperformed the US last year. And I think just about anybody would say last year was a good year domestically. France and India were the only two major countries that underperformed the US last year. So interesting that international has done so well.
Mm-hmm.
So, in terms of other assets, gold continues to be on a tear. Gold was up about 65% last year, and if you look over the last several years, it continues to increase. Biggest reason it's supply and demand. There's a lot of demand for gold right now, and there's a lot of different reasons for the demand for gold. A lot of geopolitical concerns. I always say when there's uncertainty in the world, that's when gold does well. Anticipated rate cuts. That's another reason for gold increasing. Dollar weakness. There's a whole lot of reasons for it, but it continues to be strong. Silver also, it's not on there, but we also have an allocation to silver in that equity ETF portfolio. Silver has been up. If you go back to the beginning of last year to current, it's up almost 200%. So silver's been on an absolute tear. Silver's got a little bit of different reasons for increasing than gold. Gold, people look at it as just a precious metal and a store of wealth. Silver actually has usefulness to it. It's used in solar energy. It's used in EVs. It's used in electronic manufacturing. There's a lot of different uses for silver. So silver continues to do well.
Yeah, one thing, Brad, by the way, on silver, because we saw this last week, some reports out that there's some pretty big banks around the globe.
Yeah.
The investment part of the banks, not the retail part, but the investment part of the banks that have been short silver.
Right.
As you see these moves of 7-8% a day in silver going up, and there's something going on that we'll find out later, when it becomes public. But there's definitely some big players that maybe had taken that other side of the trade when silver went from what, $30 an ounce to it's at 95 today
Yeah.
in a relatively short period of time. So, it's perhaps we'll see that some of these bigger players took short positions when it was at 60 or 70 or 50 or something, and they're getting hammered right now.
If you look at it just this morning, silver's up it was almost 7%. It's up this morning. So, yeah, those types of swings continue. And when you think about a company an investment bank going short silver, that means they sold silver that they don't own. And in order to cover that position, they have to buy silver, which just puts upward pressure on the price of silver. So we'll see where silver continues to go, but it's definitely swinging pretty wildly right now, for sure. Oil has been down, and Bitcoin finally cooled off. If you look at the last 2 years, Bitcoin, and I think most cryptocurrencies in general, cooled off. And I think there's a lot of reasons for that. I think one of the things that you can say is it's kind of part of the risk off trade. If you look at recently what's been driving returns, It's less of the Mag 7 driving the returns recently. And Bitcoin tends to trade with those assets. So that's probably part of the reason why Bitcoin is down.
Mm-hmm. And perhaps we see because at one time they were calling Bitcoin digital gold.
Yeah.
But as we see from last year, and actually, if you just look at the chart that we have here, they don't move in tandem. So you
Yeah.
may have seen some money coming out of Bitcoin and going into actual gold and silver where the returns were.
Also very interesting. You used to hear a lot of younger people talk about cryptocurrencies, now talking about metals,
Yeah,
gold and
yeah. You always
gold and
follow where the
silver.
returns are.
Yes.
Everybody wants to talk about what's the hot thing is. They don't want to talk about something that's not hot.
Absolutely.
All right, Fed cutting interest rates, which they have been doing. What's the Fed funds rate now? It's in the range of I think 3.5 to 3.75, and that was from a high of I think 5.25 at one point about a year and a half ago. So, are they going to continue to cut rates? What do you think?
I think they will.
Yeah, I believe so too.
I feel like there'll probably be one or two cuts this year, although opinions range pretty widely. I mean, I think JP Morgan just came out the other day and said they don't anticipate any rate cuts this year, but then you have other investment banks that have predicted two or three rate cuts this year. So we'll see.
Yeah, I thought it's interesting because there's arguments pro and con in this, for cutting rates, and you can see the picture on the right side of the up on the upper right. The last Fed vote that we had, the FOMC vote for rate cutting, was on December 10th, and it was a 9-3 vote, which is unusual. It may sound like a lopsided vote, but in Fed terms, it's not. Usually, the Federal Reserve tries to get consensus, and there's 12 voting members, and they try to get 12 to vote all one way before they actually take the vote. So there's a lot of, but there was three dissenters this time. One, you guys know, Miran, he wanted to cut more because they cut a quarter percentage point off the rate. He wanted 50 basis points, but there was two that said that we shouldn't be cutting rates. And the reasons they gave were we're cutting into a growing economy. The GDP, which is economic growth in this country, was up 4.3% last quarter on a year over year basis, annualized, which was higher than 3.8% the quarter before. So it's like we have a growing economy going. The argument why they should be, Brad and Justin, I think is the chart on the lower right, right? Where you see job growth has been just sort of steadily declining. It doesn't mean we don't have job growth. It just means the number of jobs being created are just less than what we had before going back to 2021. Of course, 2021 was after COVID, so you had a massive, once everybody got laid off in COVID, they all came right back into the workforce. So, but we don't, arguably we don't have a weak economy, and they're certainly not cutting because the stock market's collapsing. Stock market's at almost all-time highs. So, our way of looking at it, there is certainly, you got to look at some of the political pressure that goes on here. And it's not just, again, the president. There's other politicians that want lower rates. Why do we want lower rates? Why do the politicians want lower rates?
Lower borrowing costs, trying not to cause a recession.
Stimulate the economy.
Yeah. I mean, lower rates, right? I mean, everyone buys cars and houses, and, the lower the rates are, the more people are going to buy houses, buy cars. Businesses will borrow money to expand if rates are going down. Interesting. Brad, you made the comment before we were talking about this, before we started recording this, about mortgage rates.
Yeah, mortgage people, you have a lot of talk about, and particularly politicians talk about cutting rates to stimulate or make housing more affordable and make it so that particularly younger people can afford to buy a house because it'll push the mortgage rates down. Mortgage rates aren't really related to short-term rates, though. They're really tied more to the 10-year treasury. So lowering short-term rates won't necessarily bring mortgage rates down. So that's something that is a bit of a misnomer.
Yeah, it is for sure. And which is why, President Trump announced on Thursday last week that he was going to, he wants to buy directly mortgage bonds, direct. Usually that's the Fed's job, right? The Fed is the one that goes out, and, the Fed has this mandate. They control interest rates, and they also can print money. And oftentimes when they we've mentioned quantitative easing in here, or QE. That's just the Fed printing money essentially and going out and buying bonds to try and get rates down lower. Because when you buy bonds, you increase the price and you lower the rate. So, but President Trump came out and said that he just wants the Fannie Mae and Freddie Mac, which are the two largest lenders out there for mortgage agencies, to buy 200 billion of bonds to try and get mortgage rates down. So we'll see we'll see what happens with that. We've talked about this in these videos before for the past really maybe a year or so. Our way of looking at this is that we are in a deglobalization cycle. And, the two pictures that you see here, that's President Ronald Reagan at the top, who, if those of you who are old enough, remember, spoke in Berlin when the Soviet Union was still around, and Berlin was split into two pieces. You had the communist side, which was East Berlin, and you had the free side, which was West Berlin. And he was on the free side telling the Soviet premier, Mikhail Gorbachev at the time, to tear down the wall. And of course, we all know the Soviet Union fell, and you had a massive 30-year cycle of economies that are being freed up. Countries were working together. We started trading with all the Eastern Bloc nations. So you went through a globalization cycle, really from the late 80s going until really call it 2018 or so. And, the current administration, they want to build walls. They want to build walls. And we know, if you watch the news, all the geopolitical things that are going on. And these are not political statements, by the way, we're making when we talk about this stuff. We're just trying to see how this is going to affect your investments. But, there's pros and cons that come with deglobalization, which is also called economic nationalism. When countries start kind of closing up a little bit and taking their piece of the pie home, there's some positives that actually come with that. So if we start manufacturing things more here in this country, it's going to obviously increase economic activity. So if we're not ordering more things from China and we're starting to make more things here, wages go up. We can certainly have more workers that are involved in what we're doing here. The downsides are our wage bases here are much more expensive than China, what people get paid, which drives up prices. So there's an inflation potential downside with that too. I thought interesting, Brad and Justin, with this chart down at the bottom, and there's no label on it, but this is European defense spending. And it goes back to 1990. And there was this big trend from 1990 really through the mid 2000s, last decade, of ever declining spending that was going on with Europe with defense spending. And then part of that was all part of this deglobalization. Globalization, where they sort of trusted the U.S. to sort of back them. And so what's been going on since really late teens here, 2018, 19, 20, with this chart?
Defense spending going up.
Yeah. Why is that happening?
So these countries can be a little bit more independent. It also stimulates their economy. We've seen foreign stocks shoot up here this last year.
Yeah. Essentially what's happening is, and we saw this, Germany for the first time since World War II is deficit spending. They've always, since World War I, if people remember the textbooks or videos of people carting wheelbarrows full of Deutschmarks, the German currency, into the store to buy a loaf of bread because their inflation was so high. They've always been very, very careful about not wanting to get into debt. But they just announced they're going to start deficit spending. It means they're going to start printing money and spending money on something. And that something is going to be in defense spending. They're going to start building their military up. Japan chart looks about the same. Western Europe, the rest of Western Europe's also announced. I think the UK and some of these other countries have also said they're going to start building their defense up. Part of that is, again, the deglobalization. When you start not trusting each other as countries, that's what some of the things that happen there.
How much do you attribute that to the political unrest in the world? Russia, Ukraine, you have a lot of situations where there's not great sense of security, particularly in Europe.
Yeah, exactly. When you're not feeling as secure, that's a very good word. You're not feeling so secure, you're going to start wanting to protect your piece of the pie, which for a country is going to be their country. So there's pros that come with that. Justin, you mentioned about defense spending in these countries, which is, pushing up their stock markets. That's a pro. That's good. They're spending money. They're spending money on their own domestic industry, which is pushing their domestic companies' stock prices up. The downside with this sometimes, if you go back and look historically, is if you let this go too long and countries just keep closing up and keep closing up, it creates more conflict. And we're not predicting certainly any kind of world war or something, but these are how those kind of things can happen down the road, when the countries start doing this. So we just got to be a little careful, as a country, and watch what we're doing. I think most people are jump on AI. You guys remember we did our seminar on AI a couple of years ago when it was just sort of kind of new at the time. Now I think most people are using or have at least know what ChatGPT or Microsoft has what they got Copilot. So there's different ways to use AI. What about these companies on the side over here that we list?
It's interesting. A lot of those companies, you look at the top ones, NVIDIA, Meta, Microsoft, they're directly related to AI. The others, a lot of them are more AI adjacent, I would call them. I use CAT as a good one to look at, because CAT, people look at CAT and they think of it as a stodgy old, conservative, they just make this big equipment. The stock was up over 100% last year. If you look at it from the middle of the year, it was on an absolute tear. And why is that? It's because they're building all these data centers, and what do they use to build these data centers? They're using all this CAT equipment to build these big data centers. The stock's not cheap. Stock's trading, I think you said at 35, a multiple about 35 times earnings.
Yeah.
But there's a lot of these companies that are doing really well, and it's sort of related to the AI boom. So
Yeah.
not just technology.
Yeah, just like we had with the internet, or just like we've had with this thing, the iPhone, right? The iPhone's not just the iPhone. All of a sudden, companies started making apps for the iPhone, making chargers for the iPhone, making all kind of ancillary, different kind of things that go with it. So with AI, it's not just the AI itself, of course. It's the GE Vernova and Vertiv right there. They provide cooling systems for those data centers. Other energy sources, NuScale is being used as a power source. They build these small nuclear power plants, reactors, and a lot of these companies are saying, how do we get cheaper energy to be able to drive all this AI? So that happens. Constellation's another energy company. So there's a lot of companies that are involved in AI, which I think we're overweight in our portfolio, Justin, with our equity ETF. I think we're overweight energy.
Yeah.
By maybe 1.5% or 2 percentage points. And, a big part of that is because of this AI trade. So it's not just utilities that you think about with your house or something. A lot of it has to do with the AI trade that's going on. And then for 2026, what do we see for 2026? I think we still are looking for tailwinds for U.S. stocks. I think we still see a positive year, you guys, for 2026.
I would say so. I think you look at, there's still a lot of reasons for the market to continue to go up. There's still a lot of money on the sidelines. There's talk of interest rates coming down, which is positive for the market. You do hear quite a bit about a potential bubble in AI. But if you watch the stocks that are related to AI, every time you have a dip, people are buying the dip, whether it's retail investors, whether it's institutional investors, they're still buying the dip in these stocks. So you've yet to see a big decline in any of them.
Yeah, interesting with the AI, and again, I think we agree that we don't see the bubble popping anytime soon right now.
Right.
But, you can see these little red flags or warning signs that pop up. So for the first time, since this whole AI trade started, the big hyperscalers, and the hyperscalers are those big companies that we have mentioned in here, Amazons and Metas and Microsofts that are spending a lot of money, on AI. They're debt financing. So going back to 2023, even really late 2022, 23, 24, they were using their cash flow. Again, we talk about data centers and talk about the build out of technology. They were using a lot of their cash flow for that purpose. And I think I just read, and I'm looking at my notes, it was $120 billion last year that they borrowed to start funding some of their AI activity, which is the first time again they're going to the debt markets and getting into debt to do this. And 120 billion, these companies are worth 3 trillion, 4 trillion, $5 trillion. So it's not a huge percentage of what their company is worth. But those are little signs we look at to say, okay, if they're going to continue down that path, this has got to pay off because now they got debt service to make, as well as trying to get the investment back on their AI. So, but there's little things we got to, we watch for to say, is this bubble going to be close to popping or not?
Mm-hmm.
What about the Japanese chart we have down here? That's Japan's GDP down at the bottom there on the left. If you go back, if you guys, if you go back far enough, so Japan, and those again who are old enough, going back to the 1980s, there was a thought back in the late 1980s because Japan's stock market was going, crazy on the upside. Their real estate market was going, going up a lot. And a matter of fact, I remember they were coming over to the U.S. because they had run out of buying things in Japan, and they were buying our golf courses back then. So, and if I remember right, they were buying things like Pebble Beach, and they were going and buying these golf courses up. Real estate, they went to real estate. So they were trying to buy prime real estate, which some of the golf courses are right on the ocean. So we were buying U.S. real estate, and the thought was, well, the U.S. had its time. This is Japan's century now. It was going to be the next 100 years is going to be Japan, and then their bubble burst, and that's why you see that trend line that goes on there where it just goes sideways for a long time. The Japan GDP is about the same today, as what it was back in the late 80s. It's a little bit higher now, but it didn't go anywhere for 30 years. So when you see that trend line breaking and it's going up to the right, that means they're growing more. And again, it just supports what we're doing with foreign stocks. And we want to keep those weightings as you see some of these countries breaking out of these malaise and start seeing their economies growing again. What about gold and precious metals? Are we taking some chips off the table? Do we want to sell? What are we doing? Justin?
Yeah. I'm sorry, did you say Justin?
Yeah.
No, I think gold and silver is going to continue its run.
How come?
Yeah, I'd agree. I think there's still a lot of buying, and there's a lot of central banks around the world that are buying both gold and silver. So, and anytime you have uncertainty, you look at today.
Right.
Today, there's some concerns about potential new tariffs. Gold and silver are both. I think gold's up. It was up over 3.5% this morning. Silver was up like 6.5%. So anytime you have uncertainty, gold and silver still do well as well. So I don't know that that we'll see a big decline in gold or silver right now.
Yeah, it's typically just a nice safe haven for when you have a lot of volatility or if you have uncertainty. And it's one of those things that it seems like, daily or weekly, we're getting some sort of uncertainty that's making people a little bit nervous. And that chauffeurs people over there into gold.
Yeah, for sure. Those are excellent points. It's kind of all part of this whole deglobalization that's going on. There was a couple things that I saw with Europe, with the thing with Greenland going on and the threatening Europe to tariffs and those kind of things. Europe owns about $8 trillion of U.S. stocks and bonds. It's twice as much as anybody else does. Okay, Europe owns a lot of our assets, which has done well. I mean, they bought U.S. stocks and stocks go up. So they've done very well, but you start hearing rumblings of them wanting to start divesting some of that as they start getting a little upset at the U.S. or they start getting a little nervous, Justin, like you said. They don't feel secure. Brad used that term. That was a good term.
Mm-hmm.
You don't feel as secure. You get nervous and you start saying, gosh, maybe we shouldn't have so much money in the U.S. We should start bringing it back home. So when they start selling some of their U.S. assets, and again, they've not sold in mass, okay, but even if they stop buying, they got to use their money for something, and we see some of that money going into gold and silver. It's hard; it's considered to be hard money. So last year, I think the stat was there's 1,000 metric tons that were bought with central banks around the world, a lot of it foreign, with gold and silver. So yeah, I think we still see gold and silver going up. It doesn't mean we're not going to have corrections along the way, but I think we could probably see those prices continue to go up. And that's it. Again, thank you. And any last comments that you have, Brad or Justin?
No, just Happy New Year to everybody. Let's hope for another great 2026. We're always here if you want to discuss your portfolio. Don't hesitate to reach out.
Yep.
Keep it rolling.
Go ahead, Justin.
No, I just said just keep the market rolling.
Keep the market rolling. Yeah, we'll keep the market rolling as best we can without making guarantees.
Right, right.
And this is on video. All right. So, any questions that anybody has client wise, reach out to us. You know that, if you have family, friends that are looking for somebody to help them with their money, we're always available. Just let us know. But otherwise, thank you. And we'll see you again next time.